So welcome to this video. In this video, we are going to learn about statement of cash flow. So statement of cash flows is a useful as accounting profit is not only the indicator of performance. So it's not that accounting profit is only the only indicator of performance. Okay, we also have like statement of cash flows. As profit does not always give a complete picture of a company's operations. It focuses on sources and uses of cash. It indicates a company's liquidity and solvency. Readers of a financial statements might even be misled by a reported profit figure. So if you look at here, normally you in your normally in a company's financial accounts, okay, a company would submit through its annual reports its SOFP and SOPL, okay, and they also submit SOCF, okay. SOCF is the statement of cash flows. So if you see, the balance sheet will tell you how much the company has liabilities and equity and assets on the other side, and your SOPL will tell you how much the company has earned as profits. But if you want to know like how much cash has come into the company and has gone out of the company, you have to have a statement called as statement of cash flows. So you might ask that there is already a cash element which is being represented in the balance sheet, okay, or the SOFP. It's represented in the balance sheet such as cash and cash equivalents, okay, like that. So why should we need another statement of cash flows? See, the cash which is indicated in the SOFP or balance sheet is the year-end figure. Okay, it's just that it's a year-end figure where it tells you that on a particular date how much cash the company has. But if you want to know like how much total cash has come into the company and gone out of the company, you need to have a statement called as statement of cash flows. So statement of cash flows is also like mandatory for companies to give along their annual reports. Okay, so this SOCF is also like very useful to know the company's liquidity and solvency. So it's not only that the company should focus only on the profit. Okay, profit is like very important for the company, but if you see, the liquidity of the company is like very important. So what do we mean by liquidity? So we mean by liquidity something like assume that one of your uh, suppliers, okay, who supplied goods on credit to you, is coming and asking for money. And if you don't have cash on that position, okay, you either get a bad name from him, okay, or what happens is he might put a penalty on you or a fine on you, okay. So it's always better to have sufficient amount of cash in your hand, okay. It's not that you should have only cash, okay, but uh, any asset that could be converted quickly into cash is liquidity, okay. So that's why we usually have the ratio called as current ratio. So current asset by current liability. So company should have sufficient amount of cash, okay, which could be converted into cash, okay. Sufficient amount of assets that can be converted into cash is called as liquidity. And what do we mean by solvency? See, if we could not pay a lot of suppliers, okay, if we could not pay the salary on time, if we could not pay the bills on time, this will lead to a bankruptcy of the company, because some of our suppliers might file bankruptcy on us, okay, or they might go to the court for payment, or employees might quit us and they might go to another company. So all this problem occurs only when we don't have enough cash to pay, okay. So cash flow is a very important kind of a concept here. So we'll see the difference between profit versus cash. A company's performance and prospects depends more on liquidity or cash flows rather than profit alone. So profit is important, but cash flow is also quite important. Shareholders believe that if a company makes a profit after tax, then it can pay dividend, right? But company should have sufficient cash to stay in business and also to pay a dividend. The shareholders' expectations can be wrong. So just because a company makes a good profit does not mean the company has like good amount of cash. Okay, because the sales could have been a lot of the sales could have been on credit. Okay, so the money is not going to come immediately. It takes a long time to come, and all the payments have been made in cash. So your income is in credit, okay, and your expenses are cash based. Okay, so this kind of a company will have profit, but the only problem is they will not have cash. Okay, so investors cannot expect dividend to be paid by this kind of a company. Employees might believe that if a company makes profit, it can pay higher wages next year. But again, the ability to pay wages depends on the availability of cash. Okay, so the previous reason why a company might have profit but not cash can also lead to employees demanding a higher salary. Survival of business depends on profits, but more importantly on cash flows. Payments like raw material purchase, wages, interest, taxation, purchase of new non-current assets, and the repayment of loan capital. So all of this depends upon cash being available in a company. Okay, so that's the importance of profit versus cash. So if you are running a company, you should ensure that you are selling on cash. Okay, you are doing a lot of cash sales and you are making your payments on credit. Okay, by that way you can generate like more cash in your company. So why do we have the statement of cash flows? The aim of IAS 7 is to provide information for users of financial statements about an entity's ability to generate cash and cash equivalents, as well as indicating the cash needs of the entity. Okay, so by looking at the statement of cash flows, okay, it is easily visible how much the company is like generating cash. Okay, as well as what are the sources which are consuming that cash that is being generated. Okay, so the inflow and outflow of cash is like easily captured in cash flow statements. The statements of cash flows provides historical information about cash and cash equivalents, classifying cash flows between operating, investing, and financing activities. So it's not cash flow statement is not like a bulk statement of inflow and outflow. It also divides into headings called as operating cash flow, investing cash flow, and financing cash flow. A statement of cash flow should be presented as an integral part of an entity's financial statements. So your SOPL, SOFP and SOCF are put together, have to be prepared for the filing of annual reports. All types of entity can provide useful information about cash flows, as the need for cash is universal, whatever the nature of their revenue producing activities. So it is not only like public companies have to do it. Even private companies can create a statement of cash flow. Even non-profit organizations, even they can produce a statement of cash flow. Therefore, all entities are required by the standard to produce a statement of cash flow. Okay, so IFRS requires that all companies have to produce the cash flow. Okay, mostly like any company which has to comply the provisions of IFRS, they have to submit this statement also. So what are the advantages of cash flow accounting? So survival in business depends on the ability to generate cash. Cash flow accounting directs attention towards this issue. Okay, so it is an attention grabbing tool. Stakeholders are more interested in an enterprise's ability to generate cash than profitability. Cash flow is more comprehensive than profit, which is dependent on accounting conventions and concepts. So people feel that profits can be manipulated, SOPL can be manipulated, SOFP can be manipulated, but cash flow is like very difficult to manipulate. But that is not like entirely true. Okay, even cash flows can be manipulated. But the thing is, as you have like three statements now, okay, if you cheat in one statement, it is easily detectable in the other statements. Okay, so if you manipulate SOFP, okay, usually it was captured only in SOPL, but now if you do any manipulation in SOFP, it could be easily identified in cash flow itself. Okay, so the chances of getting caught is like now quite easy. Cash flow provides better comparison of results of different companies than profit reporting. Okay, so you can compare the cash flow generating power of a company, okay, with other companies also. Cash flow forecasts are easier to prepare as well as more useful than profit forecast. Okay, so company, if it prepares a cash flow forecast, how much they are going to earn, it's like much more useful, because like what ultimately every company wants is cash flow. Okay, not about profit. So cash is the king always. And some people get a confusion between the accrual concept. Okay, so we have discussed about accrual concept in the accounting concepts and conventions video. Okay, you can go there and have a look, or we'll do a sum. Okay, whenever we do a problem, you could look at there also, like what is accrual concept. Cash flow information can be historical and can also include a forecast for the future. So you can show the historical number as well as you can try to predict cash flow. Okay, so it's like very useful to use cash flow based accounting. Okay, so it's not a substitute to SOFP and SOPL. It's only a value enhancing statement. Okay, so it's like it should be used in conjunction or along with SOFP and SOPL. But it also has some disadvantages here. Okay, so let's see the drawbacks here. It does not follow the accrual accounting. Okay, so accrual accounting helps you to know what is the profit generated by the company in this year. Okay, the income that is being generated because of this year and the expenses that have been incurred in this year. Okay, so it has a matching concept. It has a matching concept followed. Okay, but cash flow does not use the matching concept. If you are paying any expense of the previous year, or if you are paying any expense of the next year, okay, the cash flow is going out of this year. So it only takes the cash flow into account. Okay, so the statement of cash flow does not segregate between any payment which is made for because of last year. Okay, any payment made for this year, any payment that is being made for the benefit of the next year. All it takes into account is only the cash, whether it's going out of the business or not. Okay, so SOPL is not like that. Okay, SOPL very strictly tells you the only the profit that is earned for this year. Okay, so the previous year expenses should not be recorded in this year. Next year expenses will not be recorded in this year. Okay, only this year's expense is recorded in this year. So you can see the difference between accrual and cash based accounting. The practical problem that few businesses keep historical cash flow information in the form needed to prepare a historical statement of cash flows, and so extra record keeping is likely to be necessary. See, usually companies have their data only for the purpose of preparing SOPL and SOFP. Okay, they don't have any separate mechanism to capture cash flow information. So a company has to spend additional money, okay, additional time, and have more employees to prepare cash flow statements. Manipulation of cash inflow and outflow is possible by postponing or preponing the cash flow. So this is also like quite manipulatable.